Today, I'm going to talk about one concept to help you reduce your RMD tax liability. So, I'm going to talk about a concept called qualified charitable distributions. I'm Derek Mazzarella with Gateway Financial Partners. Let's get into it. When you turn 73 or 75, depending on your RMD age, you're going to have to start taking money out of your IRAs. So, the IRS is going to require say, hey, look, I've got this IRA here. I've got all this money in here. At a certain point, you've never been taxed on this money. You're going to have to start taking it out and then getting taxed on it. I mean, you get the money, but you may not actually be in a position where you need that money. So, one way to get around this is to do something called a qualified charitable distribution. And essentially, what that does is instead of having the IRA go directly to you, you have the RMD go directly to a charity. And basically what that does is it cuts out this tax piece right here. So let's say your RMD was for the year $20,000. Okay. So instead of sending 20,000 to you, we send it directly to the charity. Now, there's a few things to look out for. First of all, there's a limit on how much you can do. So you can do up to $105,000 per person. So if you're married, you can do $210,000 in a given year. And this doesn't account against your cap for giving anyway. So they treat this as a separate act of, giving to charity. So you can give it to charity in addition to this on your own with money you've already paid taxes on. Another thing to look out for when it comes to qualified charitable distributions are you can't use it to go to a golf charity auction and buy a vacation somewhere. So you can't get any direct benefit from this. The money basically just has to go directly to the charity. Also has to go directly from the trustee. So whether it's at Fidelity or in our case LPL Financial, it has to directly go from Fidelity or LPL to the charity. You can't hold possession of the funds at all. Another thing to look out for is you're going to have to still get that document from the charity that says you gave the money, because the trustee's not going to send a document to the IRS. So you're going to have to, on your own, say, hey, look, I gave this money directly from my IRA to this charity, and you're going to have to prove it that way. So when it comes to reporting, you're going to have to make sure that you actually lay out what happened in the transaction, because you're just going to get a 1099 from the trustee. So that's one thing to really look out for. Make sure you're covering your butt with that. However, if you do this correctly, this can be a great way to reduce your overall tax liability in retirement, because many people have a tax liability like this. So it's up higher when they're working and then it drops down, then RMDs kick in, then it goes back up again. But if we could redirect some of the money to charities, maybe your tax liability or tax bracket drops down here, and then you can save potentially some tax money in retirement. So there's a couple reasons to do a qualified charitable distribution. It may or may not be right for you, but if you're looking to reduce your RMD liability, that could be a good option for you as well.